Hello traders, here. This is Chris Capri with SecondSkiesForex.com. So this is the first video I am doing on the Ichimoku price theory. I'm going to be breaking it up into two parts because there is, between all the theories, between the Ichimoku time theory, the Ichimoku wave theory, by far the wave theory is pretty much the easiest. The time would be the second most difficult, and the price theory would be the absolute most difficult. That is partially because it combines time and wave theory, whereas wave theory is not really combining price so much. It's more of like you apply wave theory to price, but you wouldn't apply a price to wave per se. And also because of it, there's just so many more calculations that you're doing, whereas within wave you're really just kind of reading the moves and applying the types of wave analysis. But with price theory, there's all kinds of calculations. Some of it is so advanced that, to be honest, it's going to take me a long time to really wrap my head around it. And so that's why I'm splitting this into kind of an introductory video, which is an expansion of some key points that I did not talk about in my Introduction to Price Theory article. So this will be the first video. The second video will start to go into some of the more what I would call intermediate concepts, and in reality they're pretty advanced, but they will be more intermediate concepts for the price theory. And then after I've been able to fully digest the last, the next section of it, I will probably do parts 3 and 4, but that's going to take anywhere from 3 months to a year to really digest all that. So for now, this will be part 1. We'll do part 2 shortly, probably in a week or two, maybe a couple weeks. Maybe we'll do that for the main video for January, and then we'll be adding more of the advanced stuff. But it's amazing because price theory, when I look at it, I even start to look at the intermediate stuff, and it feels quite complex and intricate. So that's why I want to break this down into more digestible chunks. I want to make sure that you fully understand everything that you didn't get in the article. Bring in some additional points that wasn't talked about in the article, show a couple examples of some current trades and current moves that we are in with gold and pound yen, and then show how you can apply some various wave and price calculations to it, and kind of introduce also some basic price action concepts into our analysis as well. So just to review, to make sure you understand, there are 4 main wave calculations that we're doing. Believe it or not, there are actually more advanced wave calculations, but that will be in videos like 3 and 4 down the line. The most important thing is these are the basic wave calculations, and you really have to master these inside and out. The good thing is these are not too complex, but before you could even remotely touch the advanced concepts in the wave theory, you have to have these mastered, and you have to have time theory down on quite a significant level. So we may, before we even do the advanced videos of 3 and 4, we might have to do an intermediate video on time theory, introducing some of the more intermediate and advanced concepts on that before we even get into the advanced videos on price theory. So I want to review these. These are critical. Remember, in Ichimoku price theory, we do not see things as an absolute by any means. We only use these as a general idea to pre-measure. We're not predicting, we're pre-measuring. And that is a critical philosophical way of looking at things. So we do not predict, we pre-measure. Predict means to expect something in advance, whereas prediction leads to expectation and a likely attachment to that expectation, thus causing you to lose your mental flexibility in the moment. So we pre-measure using these things, using wave and price theory as a probable course of the price movement, but we stay flexible in the case the market, and when I say market, I'm showing the price action and Ichimoku structure show us otherwise. When we have predictions when holding positions, they tend to be hopeful or optimistic, and that's being separate from what the market is showing you in real time. That's having a fixed idea of the market, and we don't want to do that. The whole point of Ichimoku is to remain flexible. And that's the whole point of trading as a whole from a psychological standpoint, is that we always remain flexible. So we don't want to see things as absolutes. We're really just pre-measuring, we're not predicting. Remember, price measurements as a whole can only be calculated after time measurements. So you have to be able to do time, and technically, okay, this is a technical truth. So technically, you're only doing price measurements after you have calculated the time measurements. And the whole point of that is that you're combining the two. Remember, price is supposed to be combined with time. As the main partner with price is time, but we're also combining with wave. We're always using all three together as a whole. But ideally, you've done the time measurements to some degree. So you know basically, hey, what are the number of candles between A and B, and between B and C, and ideally between A, B, and C, because really the whole point of price theory is to find D. The whole goal of price theory is to find D. That's what we're always doing, at least in the first set of waves. In the second video, I'll be talking some of it about second calculations, like a second leg up, and I will be talking about, in the second video, I'll be talking about, well, what happens if D is the top? How do we predict, E, F, G, and H? And so we'll be talking about that if it forms a pole black or starts to break down a little bit. So I'll be talking about that in the second video. But remember, the whole goal of measuring A, B, and C and doing all this work is that we can have an understanding of where D will be and where price will land. That's what we're trying to do, because we're trying to optimize and we're trying to really understand when are possible turning points. And D is considered to be the first major turning point or possibility for a turning point. Now, if we understand time measurements, then we can kind of get an idea. A to B sometimes is very commonly matched up with C to D. Not always, but sometimes A and B will match up with C and D. Don't focus on that too much right now. I'll talk about that more in the second video. In this case, it would only be for the V calculation. For N or E calculations, that's not the case. But, so the whole point I'm trying to say is that if you have an idea of some A, B, and C time calculations, that will be of benefit, and we'll get more into that in the second video. To recap the V calculation for an uptrend, so A, B, and C and D. To get D, we have to understand which is the B minus C part. So we take this price, we subtract C from B. That will leave us with X amount of points or pips. And then to get the V calculation, we're taking this number and we're adding it to B. For the N calculation, just to review, we take B and subtract the value of B, or we subtract the value of A from B. And then what we do is we take C. Once we know our C pullback point, then we're going to add that to the number which is found between subtracting A from B. And in the E calculation, we do the same thing. We subtract A from B, and then we add that to B. Now, if you look at these structurally, you'll see that this A to B to C, we're going to be focusing on these three calculations. NT is a very complex calculation, and they talk about it as a rarity, happening maybe only 5% of the time. But if you look at this structurally, looking at the V calculation, this is about a 61.8% retracement. In reality, anything below a 50% retracement or more is really going to be a V calculation. As you can see, E really doesn't match up to a 31.8, neither does N. N is the most shallow of all of them. And so between, all of these here, anything with a 50% retracement or deeper is going to be a V calculation. And so as long as you'll do V calculation, as long as C never actually gets to A. If it gets to A, then we really aren't doing a price calculation at that point. We're doing more wave analysis. But so if it gets to A, we're not doing a V calculation. Okay, so I think that covers it. Now, it should be known that in a bullish move, the breakout above B is really a critical event. On any of these patterns, that's when the calculation or a price measurement becomes active. If it never breaks B, if it never ever breaks B and then starts to break down and come back to C or even break back below C, then the whole thing is void, and we're now looking for a different wave theory breakdown structure at that point. So the calculation is no longer going to be void. But if it does break above B, the moment it does that, then the whole price measurement becomes active, and we're expecting a move to happen up towards D or close to that. So only once it breaks above that is we now expect D to be something that's a high probability event. Also, it should be known that the breakpoint above B in any of these patterns, B is really considered a structural point. And let me talk about that for a moment. What do I mean by it being a structural point? So when they talk about it in price theory, they talk about this being the S or the structural point. Basically what it means is that when you break above B, there's a decent chance that the first time you're breaking above B, you could get a breakout pullback to this level. It's more likely that you'll get that in an N or an E calculation, whereas in a V calculation, usually with a deep pullback, to break above B, there has to be a significant amount of force behind it. Whereas here, we're going to see some stops above it, and part of that is also because we've been below B for such a long period of time that if B rejects it a second time, we make a higher low, which doesn't form, an equal to C, and then we break above it, then more than likely those stops have been tripped and it should run pretty fast. But with B and C, there's a good chance that we break above it and there aren't that many stops behind it, because if you look, these are more shallow retracements. And being more shallow retracements, that means there's generally less stops behind the B point there, or the structural point. So there's a good chance that we'll break above it and create a pullback level to this. I'll talk about that a little bit further, but just know that that B point is really a key structural point in the wave and the price and price theory and the price action as a whole. So key points to remember that. We'll talk about that in a little bit here. I'll show you in one of the examples. Okay, so I think that's pretty much all I needed to cover in terms of the V calculation, the N calculation, the E calculation. Between the two, N and E are pretty similar. It's more often than you're going to be doing an E calculation than an N calculation, but there are some times where you have a shallow move here in the N calculation. So the more corrective, and for those of you that understand the price action that I've talked about, impulsive versus corrective, the more corrective the move, the more likely it will be an N calculation. If there's some decent impulsivity to it, there's a good chance it'll be an E calculation. As you can see, E is a deeper pullback than the N calculation is. Also, N is known as two layers. You kind of think of it as like two geological layers. For any of you who study geology or know anything about it, how formations of rocks will kind of layer on top of each other. The whole point of this is that the C to D layer is generally equal to about, and that's what these lines right here are saying, is the C to D layer is generally equal to the A to B layer as a whole. It's almost like the two layers forming on top of each other. And they generally have a certain level of consistency to them. So that's pretty much what I wanted to cover in terms of these here. Let me think if there's anything else. In terms of the V calculation, the first leg should be a pretty sharp rise. You'll notice that it's sharper than both of these here. Let me think if there's anything else. And a sharp pullback. So, it's a sharp rise. They ran to some strong sellers and a strong pullback here, which is different than, say, the N calculation. For the N calculation, the main calculation is that it represents the first rising part of an N wave. So that's usually what an N calculation is, the first rising part of an N wave that we're talking about, which will equal the second rising I wave. So the first part of this here will generally equal the second part of this here. So the pullback is much more corrective, as I mentioned, and less shallow, and it's the least corrective of all of them. For the E calculation, also known as the two layers, the first rising wave from A to B is basically, as I said before, the second layer C to D is added on top of this here. So that's what we need to know about the E calculation. Okay, so getting back to this here, this is a chart on the pound yen 4-hour chart, and we're going to be breaking this down, as I said, from wave count, looking at it from price theory. We're going to be doing all of the calculations so that we can kind of show you how this applies, show you some of the key points and techniques, what you need to be seeing, what you need to be understanding, and how we can work with this. Okay, so we're going to analyze this series of bull moves here. In this first bull move, we have an I wave here. For those of you who remember from the I wave series, the pullback is pretty darn corrective. If we were to look back at this thing here, it's tough to say whether this would be an N calculation or an E calculation. It could honestly pass as both. It has some elements of that. But the bottom line is that, in fact, we could even walk through the difference of it being an E calculation and the difference of it being an N calculation. So why don't we do that just for perspective? But because it's really not that deep of a pullback, it could really be either. The easier one to tell is the V calculation because 50% or greater. Generally, when in doubt, according to Ichimoku theory, there are more E calculations than N calculations. That's just how it ends up working out. So, but we'll try both on this one. We'll try an N and we'll try an E calculation on this one here. Okay, so with that being said, okay, so I've marked some of the key points here. A will mark the bottom here. Let me put some lines up. So A marks the bottom of this most recent move. B marks the top of the first I leg here. C is the pullback. Notice how it goes right to the Kumo and then bounces from there. We'll get into the A prime, B prime, C prime, and D prime later. I really want to focus on A, B, C, and D because this is a general example of how you're going to do a calculation. So let's take a look at this now. If we remember back from our model here, we'll start with an N calculation. So it's C plus B minus A. So we need to take B, subtract A from B, and then add it to C. Whatever the remaining value of this is, added to C. So going through this here, subtracting A from B, what we need to do is bring in a calculator. I'm doing these calculations right in front of you. So A is 125.66, B is 132.41. So we take 132.41 minus 125.66, and we get 6.75. Okay? So we have 6.75, remember that. And then we go back to the calculation, and we need to add this to C. So from here, what is C? C is our pullback level. Remember, you really can't start any price measuring until you have A, B, and C. So you can't just do A and B and then start to do price measuring. You have to wait till you have A, B, and C. Once you have that, then that's when you start doing the price measuring. Well, we know C is 130.56, so when we add this to 130.56, what do we get? We get 137.31. Now, looking back on this, 137.31 is not too far off the highs. In fact, it's pretty much one day before the high. So the candle that closes right before this would have been one day before the high in the pullback of D. So this is how we use it as a price projection. And so critical information for us here. Now, that is using the N calculation. Let's do the other calculation, which is the E calculation. And just to show you real briefly what that is, the E calculation is we have to subtract A from B and add that to B. So let's go back through the math again. And so we're going to do 130.56 minus 125.66. Wait a minute, that's not right. Sorry, that's C. My apologies. 132.41 minus 125.66. 6.75. And then now we are going to add this to B. So going back to that, we go to our calculator and we add plus, sorry, I'm doing this right over here, plus we add it to B, 132.41. And our calculation is 139.16. So moving this up here, 139.16, the day that it actually hit that price, this might actually do it. This was the first time it reversed in 1, 2, 3, 4, 5, 6, 7, 8, 9 candles. This is a 4-hour chart, so 36 hours. The first time it reversed was when it actually hit that pretty much price target. What did price do after that? Went just a few pips higher and then pulled back before the holidays and before it started resuming again. So we can see both the N calculation, which predicted within a 40, 50 pips of D, and then this one here that picked within 40 pips of D prime. This one here, both of them, the N and the E calculation, picked the reversal. Now, the fact that, or picked the a turning point. The difference between the two is that I like how when we get to the D calculation, which is from the N way or from the N price measurement, we had a significant pullback that had not only pulled back below the Tenkan, below the Kijun. That to me tells me that there was a decent amount of selling and a decent amount of pullback there, that a move could have reset. We could start a new wave, whatever it was. But the bottom line is, in this case, I like the N calculation better. The N calculation just played out better in terms of when the market actually started to pull back a little bit or had to have a turning point. Now, of course, to have a full turning point, we would need to be breaking below the other side of the Kumo, and we haven't had that. So then what are we looking for? Well, going back to wave theory, we're still looking for N waves up, and we have the same thing here. This is just another N wave up. And since we're looking for another calculation, well, then we have to do, again, another calculation to measure a price target. So that's where I started marking A prime, B prime, which is also D, C prime, which is the pullback, and then D prime. I don't know why I picked D prime there. We'll get after that. But let's start to mark some of these lines again here. So I don't really need this line anymore. I don't need this line anymore. And I don't need this line anymore. And we're going to use this price measurement theory to kind of give us an idea. Also, take a look at this pullback where an A prime is. If I zoom into it, you will see it pulls right back to the Kumo bottom. 2 bounces off a flat Kumo bottom, and then it takes off. 2 bounces, and then it does a Tenkan Kijun cross. That should be a fantastic buy signal using the TKX model, basically. This is just a fantastic buy signal using traditional TKX signal. So, okay, so let's pull out the N calculation again here, which is we need to subtract A from B and add it to C. So C, we'll need to subtract A from, I keep forgetting that. Okay, yeah, A from B and then add it to C. So bring out Mr. Calculator again. Subtract A from B. We know what B is. B is 137.86 minus 131.63 equals 6.23. And then what are we adding it to? We're adding it to C. So what does that mean? We're going to take our calculator and again, plus add it to C, which is just here. And let me put a line there. Now we know our C. So we're going to take 6.23 and add it to 135.87. And what does that get us? 142.1. So according to the price theory of the second leg up, we still have, using the N wave, we still have a ways to go. In fact, 142 is going to be way up there. I can't even put it on my chart right now. So, and we're seeing a confirmation of that. Look what happened since we've had the Tenkan Kijun cross. And remember, when do these price measurements become active? When they break the high, in this case, this would be the B point or the B prime point. When they break this point here, that's when the price measurement becomes active. And so look what happened since then. Since we've climbed this, we haven't broken below or closed below the Kijun. So we still got a long target in play, and so we'll be keeping an eye on that one there. Remember the number, 142.10. I don't know how this is going to play out. Just for the sake of it, let's do the other calculation that we have, which is the E calculation. Subtract A from B and add it to B. And let's see if those numbers have a confluence there. So subtract A from B, and so our B is 137.86 minus 131.63, 6.23, and we add it to B, 137.86, and we get 144.09. So 142.10 or 144.09, depending upon the two calculations. Now, I'm not sure if I can go back far enough, because we haven't been this high in a while. But if I pull out the daily chart, I'm probably going to lose. Wow, this sucker's just been massive. Nothing in the last 6 months. Let's see if anything in there in the last year. 142.10. Nothing in the last year we've been this high. So we have to go back over 3 years. We've just broken a huge resistance here at 140. And so let's see if there's anything at 142.10. Nothing quite there. I mean, there's some decent actually right there. Some decent resistance there from this stuff way back here. And 144 point, what was that number? 144.09. So, not quite. It's all parked around 145. So looking at this, I would be expecting this series of moves to end around 145 before we get a decent pullback. This is just an incredibly bullish run. I don't see how it can go, even if we just zoom in. You know, for those of you who've seen the price action, you know, this is pretty much almost parabolic. It's just had an enormous run. It's not that I wouldn't chase this. If the right signal came, I would take a breakout on this one here. But I'd rather wait for a pullback on this one. I will tell you, though, if I start to see reversal signals at, between 142 and I'm thinking more around 144, 145, I will look at counter trend playing this pair. Maybe something on the inverse TKX or maybe something on the Tenkan OCX, I will consider those two as options. But that's what I'm seeing on this one. So that's how we do some price projections on this point. Now, when we start to see, in the next video, I'll show you how to do counter trend pullback projections. In other words, we see pullbacks that never break the B point, like a pullback that would have never broken this high and then breaks below the Kumo. Then we start to need to do other calculations to see where the projections are. As a general rule, if we have an N wave, so here we have A, B, C, and then D, if we ever did a counter trend pullback projection that took us back below A, we would negate the projection, because for a counter trend pullback after an N wave to break all the way back below the A wave in one price measurement is quite extreme. That's a massive reversal. So we would not do that. Let me think of some other notes. I've gone through the basic calculations here. I've shown you an A, B, C, D, and then an A prime, B prime, C prime, and D prime of where things should be. Let me see if there are other calculations or other notes. I'm looking at my notes here if there's anything else I want to mention. As you know, when we're doing a bull run, so the way the calculations work out, in this case it's B plus B minus C. Well, in this case we have to subtract the plus for a minus. So B minus C in this case here. So that's how we have to work with those basically. Instead of adding the value of what's in here to here, we subtract it from here. It works out the same way. That's how we get our price range, but that's how these work out. If there's anything else I want to talk about before I go into my next example. Again, you're almost always using V, N, and E, and when the difference is between the N and E calculations, more often you're going to use an E than an N calculation. Anything else? Looking at my notes. Okay, here's something I want to, I guess I just want to talk about this a little bit. So for those of you that really, and I think I've mentioned it earlier portion of the video, but just if you think about it, the difference between these moves is really just the level of correctiveness, the level of aggressive selling in this. So for those of you that understand how to calculate impulsive versus corrective moves, this is going to be highly valuable for really determining whether it's an N or an E calculation, and also determining whether we want to possibly take a look at a follow-up signal. Now, I haven't talked about how you actually trade these price measurements in terms of actual trade signals. There are a couple ways that you can actually trade this. One is maybe you're already in a trade. Maybe you're long from an inverse TKX way at the bottom, and you're deciding whether to get out, or you're deciding what would be a decent price target. Well, maybe you see this, you're in this long move here. Many of my students, and many of you did send me emails saying you got in this and you showed me the charts. Fantastic for you guys that did. But you see this chop here, and so maybe there's something that's informing you there's going to be a follow-up signal. So the question is, how can we actually trade this using this price measurement theory? I'm going to give you a pure price measurement method once I go over one more example, and then I'm also going to talk about alternatives. Maybe you're still in an inverse TKX and you think there's more upside. How can you use price measurement theory or additional techniques to stay in the current trade, or add in a new trade via a new signal? So I will talk about that soon, but there are ways to trade these price measurements other than trading signals that you're already in. Maybe you're using a traditional TKX signal and you want to know, hey, when should I start looking for the exit? Well, that's part of what the price theory is, or that's part of what time theory is for, and that's part of what the wave theory is for, is that you start looking for waves to be supported, overlapping waves, N wave followed by another N wave, also time cycles as well. We want to be watching for these, but I'm going to give you some other hints and some other methods as well. So I just want to go over one other key point, and then, or one other example, and then I want to get into that. So let's take a look at this one here, which is a downward example on gold. And we're going to do the same thing. And I'm going to show you some overlapping wave analysis on there. So we're going to go over an A, B, C, D, and then we're going to go over a B. Well, this will be, sorry, this will be, I think I did this wrong. This will be A, B prime, this will be C prime, and this will be D prime. So my apologies on that. Let me see if I can delete this. Yeah. Okay, good. Sorry to be doing this in real time. I apologize. I just realized that it was like that now. And this will be B prime here. B prime. Every time I say it, I feel like saying Optimus Prime for Transformer fans back in the day. Shows how old I am. Okay. So let's go over this example because this is slightly different. This could be done in a couple ways. So let's mark this here. We have our A, our top here. We have our B, our first pullback point. We have our C right here, and then we have our D portion of the move. Now, let's do the calculations. We can tell that this is not, because it's, if you look at the distance 1705 to 1754, that is what, $50 roughly, and the retracement is 25 of that 50. So since the retracement is about half or more, we have to be doing only one type of calculation. That's the V calculation. You can't do that on an E or an N calculation. So we're only doing a V calculation. So what we're going to do is we're going to subtract B from C, and then remember this is a downtrend, so we have to subtract this value from B. C from B, and then subtract that value from B. So let's take a look at this here. And so here's C. C is 1731.72, and this is 1705.88. So let's take 1731.72 minus 1705.88. What do we get? 25.84. And then going back to our calculation here, oops, wrong one, my apologies. Going back to our V calculation here, we need to subtract this value from B. So here we are, we got this, 2584, and we're going to subtract it from B. So 2584, subtract it from that. 1705.88 minus 25.84, 1680.04. And so that puts us right around here, which is actually pretty decently close considering how volatile gold is. It's pretty decently close, came close. The key point here is that if you start to see, you know, up to this point we had not seen a triple bottom effect here. We had seen a bottom here, almost a double bottom breakthrough, roll reversal level, but look what happens here, bottom, bottom, bottom. So at that point we should be thinking, hey, this is the whole point about the flexibility of the price theory. Hey, we are seeing triple bottom, we might not be able to get there, so we should start looking at reversals at this point here, or possibly exiting for profit. But that gives us our first D point right here using this smaller wave structure. And if I delete this out and look at the larger wave structure, so we're going to do this. A to B prime to C prime to D prime. So let me mark the C prime. And again, this is the same calculation. Why? We're doing a V calculation because it's a 50% or greater retracement. Anytime we retrace half or more of the move, we have to do a V calculation. So going back real quick, V calculation, subtract C from B, and then subtract it from B, that value from B. So let's do this again. In this case, C in this case is 1723.21 minus 1684.79 equals 38.42. And we're going to subtract 38.42 from 1684.79. So remember that. Minus 34.82. And that gives us 1649. I think that's right. Yeah, I think that's right. So 1649. Now, the market in 1 4-hour candle shoots right past that. And then it double bottoms, and then it breaks back above it. So in that case, I'm looking at this as a pretty much this leg is done. This V wave is done at this point. Now we're going to need to see either a pullback to here and sell off back towards D, a break below D before we even consider a follow-up N wave. But until we break below D, we can't do any follow-up N wave calculations. And when I say N wave, I'm talking about the wave theory calculations. So that's where we're at right now. In this case, it overshot a little bit, and that's the point that, you know, hey, it's not going to be perfect. So we have to understand that this is not going to be a perfect system, and that we're just using this as an approximation. Once we see that price hit, that's where we start looking for the market to reverse, and we look for signs in the price action. Now, a couple points I want to talk about here real briefly. Let me delete this here. I could just do that. Okay, take a look at this here. For those of you who have taken my price action course, what do you see here? You see an impulsive move followed by a corrective move right to a 20 MA and a flat bottom and a Kijun. If that is not a sell signal, I don't know what is. Anytime you see that kind of confluence of signals, we have to understand that that is a selling opportunity for us. That's what we're looking for as Ichimoku traders. We're not just looking for what we see in our system, we're also looking for opportunities that present themselves. I have been considering for a long period of time of creating a hybrid course, which would be a hybrid Ichimoku and price action course, and this would only be available for those of you that have taken both the price action and Ichimoku, so I can start talking about advanced signals that I look for when combining Ichimoku and price action. If that sounds interesting to you, let me know. Comment in the course. What's your thoughts are. Not via email, but comment in the course if you're interested. I would probably do it for, like half price of what the courses are, and and so forth. But if that sounds interesting to you, let me know. Now, in terms of how do we trade some of these things, and I'm kind of wishing I hadn't traded or canceled out the sterling yen chart. In terms of how we trade this, from a price theory perspective, if you're already not in a position, there is a way to trade that. And that is, remember, the B point is considered the structural point. That as we have A, B, and C, what we're looking for is B to be broken. So one way that we can trade this is we look for a breakout pullback towards that B point or that structural point. That can become an entry for us. Ideal is if when it comes to that point, it's running into a Tenkin or a 20 EMA, maybe a Kijun, depending on how far it is. But one of our trade signals, remember, the price measurement theory does not become active until we've actually broken the B point or the structural point. So when that happens, then we start looking for the D measurement. But there can also be, according to Ichimoku price theory, there can be trade signals there. Breakout pullback towards that level, maybe look for a retrace back to a Kijun. Those are all possibilities. Another possibility is we wait till we get the pullback to the C point, or in this case C prime, and then as we see the C prime broken, in this case, then we're looking for the D point to be broken. So maybe a possible breakout pullback. We didn't get it here in this one here. Maybe on a lower time frame we did, but this candle is quite aggressive. So start to look for possible trade signals around those structural points. It might be a Tenkin OCX signal that gives you something. It might be a Kijun ATR signal. It might be a Tenkin Kijun cross on a lower time frame. Look for signals around those points. It's probably more likely that you would get a signal on, in this day, here we go, ABC. We break the B point here, we get a pullback, and then on a lower time frame, you get a new Tenkin Kijun cross. So that's when we'd be looking for that, looking for a signal around this level here and targeting minimally the D point here. So that is some methods as to how we can use that. According to price theory, we look at that structural point as either a confirmation that we want to stay in our existing trade, or if we're not in an existing trade, then we need to look at possible new signals occurring around those levels. This is absolutely critical. But anytime there's a confluence of signals, then we need to be looking to be trading that, because what do we have? We have a wave theory continuation signal with the N wave here, boom, 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 boom. We have a breakout of the structural point from price theory. We have a target. We have pullbacks to the Tenkin in this case here. We have it to the 20 EMA Kijun and flat Kumo. These are all confluence of signals from an Ichimoku perspective. So we need to start looking at these and say, hey, are there opportunities here? So this is absolutely clear. But again, once that B point or that structural point gets cleared after C, then B often will become a pullback support level, possibly to an EMA, possibly to a Tenkin or Kijun, which could be an opportunity to get short or long depending upon how that works out. But remember, once we start getting towards a D, then we need to see a reset of signals. We need to see a reset of, kind of confluence of signals before we consider getting back into it. So hopefully that answers that gives you some ideas right there. Okay, so I think that's pretty much all I wanted to cover for right now. Again, remember, we're pre-measuring for a possible course of price movement, but we stay flexible in our mentality. We do not use these as predictions because that leads to a bias, and in particular an optimism bias. And we need to stay mentally flexible and see how these things go. These are all critical. Remember, the three types of price calculations that you're doing are always a V, an N, or an E calculation. And master these first. Get some practice in this first. Also make sure you combine time theory with this as well. and also your traditional waves as well. Get some practice with this. Spend some time with this. Maybe in a month or two, I'll do the second version of this video, second intro to it, and then I'll start working on the more intermediate and advanced stuff. So I hope you enjoyed this. I look forward to your questions on this and hearing from you. Also, make sure you give me feedback on the combo course if you're interested. I'm imagining this is going to open up a whole new set of discussions. As I mentioned, a lot of points in here that I did not mention in the article. So hopefully that gets you to start to think about things at a more developed level. And so that's pretty much it. I look forward to seeing you on the forum. Happy New Year's. And of course, I look forward to working with you in 2013. Good luck trading, everyone.